let's get into what I'm sure you really want to talk about, the accounting equation. The best way I found to describe the accounting equation is to talk about it in terms of a house. All right, let's say you had a $250,000 house and you put money down on the house, a $50,000 down payment. Well, how do you get to the other $200,000 that the house cost you? Well, the way you get to that extra $200,000 is you take out a mortgage on that house, right? So you have this house of $250,000, you have a mortgage of $200,000, and you put about $50,000 down when you purchase the house. Well, the asset, or rather the house, is referred to as your asset. Your asset you got by two things. You put money into the house. That was your down payment. That's your equity in the house. And you owe $200,000. That's your liability. Okay, so the idea is assets come from one of two places, either from stockholders' equity, or rather the equity that you put in, and from liabilities, right? You still owe the money. So it's one of those two places. So that kind of helps a little bit, but when we think about how the accounting equation works, but this is it. Assets equal liabilities plus stockholders' equity. That's your accounting equation. Let's give you a few more examples of assets. All right. The assets are resources of your business. Things like buildings, land, machinery, cash, accounts receivable. We'll talk about that in a bit. Inventory, supplies. Those are the assets. Those are the resources of your business, the resources you have to run your business. Liabilities are things you owe. All right. So it's not necessarily you owe money. Most of the time, that's what a liability is. But you could also owe somebody a service, and that's unearned revenue. Right, so accounts payable, notes payable, anything with a word payable on the end of it, for your purposes, is a liability. And unearned revenue, we'll get there, but that's a liability as well. Stockholders' equity is really your stock and your retained earnings. Again, we'll get there. If you put $50,000 into the business, what the business gives you back is stock. So that down payment would get recorded there. Retained earnings is just that, money that you have made in your business, earnings that you have retained or held on to. And we'll get into, like I said, examples of this as we go along. Oops. Well, I forgot I did this. Retained earnings comes from revenues, the money you earn, minus your expenses, minus any dividends. Okay, like I said, make sure you have these in your notes. You'll be able to refer back to them. At this point, like I said, it may not make a heck of a lot of sense, but we'll go into all this stuff in a lot of detail as we go along. All right, now this is a lot to look at, I know. But I feel like you need this in order to get through some of the homework problems and have a better understanding of how this works and how the accounting equation works. So what we have is we have it broken down into assets, liabilities, and equity. And we've got the contributed capital as your common stock, and you've got your retained earnings categories here. Okay, and we just saw retained earnings categories are revenues, expenses, and dividends. Okay, so here's a bunch of transactions that happened, and we're going to look at them one by one and kind of walk your way through them. I'm going to do it pretty quickly because you can always rewind me and listen again. Joe Smith deposits $20,000 in a bank account for VideoMax, a corporation, in return for shares of stock. Okay, so you're always going to have at least two transactions. It's called double entry accounting. At least two. Sometimes 3, sometimes 4, sometimes 6, but at least 2. All right, so what I want you to think of is I don't want you to think of the words debit and credit if you've heard those yet. Hold those off until the next chapter. Think increase and decrease for now. All right, so from the business's perspective, Joe Smith deposited $20,000 into a bank account for VideoMax. What they got, VideoMax, was cash. They got cash of $20,000, so it has an increase in the business, has cash, an additional asset of cash for $20,000. And they gave out shares of stock. That goes into your contributed capital, common stock, $20,000. So you have at least two transactions. You have an increase to the account of common stock, and you've got an increase to the account of cash. VideoMax buys land for $5,000. Okay, what did VideoMax get? They got land. So we are going to increase the account for land of $5,000. That is an asset account. All right. On the flip side, they bought land for $5,000, so really their cash had to go down for $5,000. So they have at least two transactions. They don't need to be on both sides of this line. They can be on the same side. That's fine. It still balances, right? Plus and a minus. You're exchanging one asset for another. All right. VideoMax buys supplies for $2,000, agreeing to pay the supplier in the future. Okay, so what did VideoMax get? They got the asset of supplies. So there we go, supplies $2,000. When you owe someone, that's a liability. You're going to pay them $2,000 in the future. It didn't say you paid cash, it said you're going to pay them in the future. That is a very typical liability, the most typical. When you owe someone money, it is called an account payable. Okay, $2,000. Now, you might be confused by the plus here, but the idea is you're increasing the account of accounts payable. You had no liabilities before, now you do. So you had 0 liabilities, now you have $2,000 in liabilities. So you're increasing the account of liabilities. VideoMax earns rental fees of $8,000 receiving cash. You know, when these have cash in them, I always like to start with cash because it's kind of the easiest to get your head around. So right now, you know that they earned rental fees of $8,000. They received $8,000 in cash. There's your $8,000 in cash. And their job, I guess, is renting videos, which isn't even a thing, but, well, kind of Netflix, right? But anyway, earns rental fees. They did their job, right? They're earning rental costs. So that is going to be rental revenue of $8,000. Like I said, don't stress out if this is all new for you. This is the first time you're hearing these things, and it's okay. You're going to do it a lot over the next couple of chapters. All right, VideoMax paid wages of $3,000 and rent of $1,000. Well, if we're paying somebody something, that affects our cash, right? So that's going to be a decrease to cash of $4,000. So let's start there, $4,000. And if we're paying wages to someone and we're paying rent, those are expenses of running our business. That falls into this retained earnings area. So that's going to be wages expense and rent expense. Now, Professor Anderson, you said I only needed 2 entries. I said at least 2. So here's 3, but I still balance. 4,000 on one side, 4,000 on the other side, we're all good. Don't worry so much about the minuses here. The minus means it's an expense to equity and it's bringing the value down, like revenues are a plus, expenses are a minus. Don't get too hung up on the minus and pluses. When we get to debits and credits, it'll make more sense. VideoMax paid $1,500 to creditors on account. All right, let's start with cash. $1,500 came out. And creditors are people we owe money to. So we paid them. So accounts payable. Remember, accounts payable is where we owe money. Now we've paid some of that money, so we're going to subtract $1,500. At the end of the month, the cost of supplies on hand is $700. Okay, I think that's a little too complicated for this stage of the game, but we'll do it anyway. What we started off with, we started off the month with $2,000 in supplies. All right, so let's see. Let's see if I can do it behind me big enough for you guys to see. We started off with $2,000 in supplies, and then at the end of the month, we go to count how many supplies we have, and we only have $700 in supplies, right? So it's like beginning and ending. So the question is how many supplies did we use during the course of the month to run our business? We had to have used $1,300 in supplies, right? Because you see, we started the month with $2,000. Now they said we only have $700 at the end of the month, so we must have used $1,300 in supplies. So if that's the case, I've got to reduce my supplies account. It's not really $2,000, right? So I've got to subtract $1,300 there, what I used, because now that will give me the ending balance of $700. Also, I needed to use those supplies to run my business, so that is going to be a supplies expense. Right there, $1,300. Last one. VideoMax paid $2,000 dividends to stockholders. Okay, well, dividends are the share of earnings. When a business pays out dividends, basically what they're doing is they're saying, look at us, we did well this year, and we want to reward you guys for being our shareholders. So when a business pays money out to its owners, that's called a dividend. All right, so we've got a minus $2,000 in cash because they're paying out dividends to the owners. And we've got one more account here, dividends, $2,000. All right, so I'm going to throw all the totals in here because we're going to need those totals momentarily. And if you wanted to add them all up, you could see assets equal liabilities plus shareholders' equity. All right, 21,200 equals 500 plus 20,700. Feel free to check my math. All right, let's see. I don't really want to do a fourth video. Let's see how quick I can get this done. No, I don't want to rush you guys. Okay, I'll do one more.